Hello and welcome. Today we're doing a deep dive into the mind of legendary Indian investor Basant Maheshwari. Specifically, we're unpacking Chapter 2 from his book, Uncovering the Market Mysteries. We'll be analyzing his exact teachings, his mental models, and his core investment framework. If you've ever wondered how the true market masters actually compound their wealth over time, well, you're absolutely in the right place.
Let's kick things off with a pretty wild question straight from his teachings. Why is there a 100 times difference in the net worth of two people who have the exact same level of intelligence? It really makes you think, right? It totally challenges our standard assumptions because it turns out it's not really about raw brain power or how much data you can crunch. It's entirely about your psychological framework and your actual investment strategy. So here is our roadmap for this explainer. First, we're going to tackle the mystery of the market. Then we'll talk about cultivating the right mindset, break down his highly effective BMV framework, learn exactly how to spot multibaggers, and finally look at his concentrated portfolio strategy. All right, Section 1, the mystery of the markets. Let's uncover some early truths. 9 whole years. That is exactly how long it took for even a total master like Basant Maheshwari to stop consistently losing money. Starting way back in 1991, he was taking tips, chasing whatever stocks were moving, basically doing exactly what the crowd did. And it just goes to show that the market will literally humble absolutely everyone until they build a solid, reliable framework. So why do we even put ourselves through the struggle of figuring the market out? Well, the ultimate goal isn't just about chasing, say, a quick 5,000 rupee daily profit like a day trader. Not at all. It's about building a wealth corpus of 50 times your annual expenses. Think about that for a second. Once your portfolio hits 50 times what you spend in a single year, you've done it. You have achieved true mathematical financial freedom. That's the real goal here. Moving on to Section 2, the right investment mindset. This is where psychology completely overrides the math. There is a massive psychological gap between your average retail investor and a market master. The typical retail investor kind of panics during market corrections, right? They desperately chase those 52-week lows, constantly hoping they're scoring some cheap bargain. But the thoughtful investor, they operate completely differently. They hold for long-term compounding, and they really aren't afraid to buy at 52-week highs because they recognize that a stock breaking out is often backed by a massive, powerful sector tailwind. Now, this brings us to a crucial point. You have to avoid the value trap. This is an absolute portfolio killer. A value trap is a business with low growth and a super weak competitive moat, but it trades at incredibly cheap valuations. It constantly lures in retail investors who think they're getting a steal. But listen, it is cheap for a reason. You really want to steer clear of these. Section 3, the BMV investment framework. This is really the core strategy. BMV. It stands for Business, Management, and Valuation. And for this to work, all three of these pillars have to align perfectly. First up, the business. It has to be scalable. It needs to address a large market opportunity, and it must have a high return on capital employed. Basically, the company needs to be a machine at efficiently turning its capital into profit. Second, management. The team running the show must be top tier. You really need to pay special attention to how they behave and how they treat minority shareholders when a crisis hits. And third, valuation. You can't just look at a simple one-year PE ratio. You have to take a full cycle view to ensure you are actually paying a reasonable price for that long-term growth. And all of this builds into this brilliant growth moat matrix. Imagine mapping companies based on two things, their rate of growth and the strength of their competitive moat. Those value traps we just talked about, they sit way down at the bottom right. On the bottom left, you have your cash cows. They provide stability, sure, but your ultimate goal as an investor, you want to identify the stars at the top left. High growth, and a rock-solid moat. And you want to find them early, way before the broader market catches on. Section 4, identifying multibaggers. Time to look at the strict screener. Okay, so here is a highly actionable 5-point quantitative screener you can use. Number 1, return on equity simply must be above 30%. That shows highly efficient wealth generation. Number 2, sales growth needs to be consistently hitting 25 to 30% over the last 5 to 6 years. Number 3, the company absolutely has to be a sector leader. Number 4, a price-to-face value ratio over 100. That tells us the market highly values the company's core equity. And finally, number 5, low debt. It's an incredibly strict filter for sure, but it completely removes all the market noise.
And when you actually apply that strict screener out there in the real world, the results are literally staggering. Just look at some of these past multipliers from his own holdings. Page Industries gave a 20x return. Pantaloons Retail gave a massive 40x. Hawkins Cookers yielded 8x. When you combine those super strict criteria with just immense patience, the wealth compounding you get is nothing short of spectacular. But part of finding the huge winners is aggressively avoiding the losers. He is very strict about avoiding public sector undertakings, meaning government-run companies. He also totally steers clear of highly illiquid small caps, where you can easily get trapped, as well as commodity cyclicals. Why? Because commodity companies just lack pricing power. They simply do not offer the predictable earnings and the long-term stability you actually need to create massive wealth over a decade. And that brings us to Section 5, Concentrated Portfolio Strategy. How to size your bets for real wealth. Think about an over-diversified portfolio like your standard traditional mutual fund. It's essentially a slow, heavy Titanic. Sure, it's safe, but it barely moves. A concentrated portfolio, on the other hand, is like an agile speedboat. It's driven by deep research and extremely high conviction. By avoiding over-diversification, you make sure that your absolute best ideas aren't constantly getting diluted by your mediocre ones. So what's the magic number? How many stocks should be in that speedboat? Well, it's 10 to 12. That is the maximum number you need to consistently beat benchmark indices like the Nifty 50. If you add any more than that, you are honestly just dragging your returns right back down to the market average. Now, within that concentrated portfolio, there is a very strict risk allocation rule you have to follow. Cap your exposure to any single company at exactly 30%. This creates the ultimate balance. It gives you massive upside if your high-conviction stock really runs, but that 30% cap protects you from total ruin if your thesis just ends up being wrong. As we wrap up this masterclass, I want to bring this explainer to a bit of a poignant close. Wealth means peace, security, and comfort. It's a great reminder of the profound human element behind all of these numbers, screeners, and frameworks. Because at the end of the day, we aren't just picking stocks so we can stare at a green screen. We're investing to literally buy peace of mind and security for our families. I'm going to leave you with this final provocative thought. Are you just trying to slowly beat inflation, or are you out there actively building a portfolio designed for true financial freedom? Think about the BMB framework we dug into today. Challenge your current strategy and start applying the lessons from this explainer to your own investing journey. Thanks so much for tuning in. Stay thoughtful out there and keep learning.